Hi guys, welcome back. Google stock has been lagging behind lately. With AI exploding, lawsuits piling up and investor doubt mounting, it's easy to think that this tech titan might be past its prime. But what if I told you that the market might be getting this completely wrong? In this video, I'll be digging deep into Google's business, from the actual AI and cloud adoption numbers to their Moonshot projects and what is really happening behind the scenes with Gemini and those custom TPUs. I'll explain why I think that Alphabet might be building the strongest AI ecosystem in the world. And if you're new here, my name is Florian and I'm a physics engineer and former IT guy who's now working in the middle management of a semiconductor manufacturing company. I bought my first stock when I was 17 and I want to share my experience and investing journey here with you. So thank you for joining me today. Over the last year, Google stock had quite a high volatility. But as of right now, the company has underperformed the broader market with minus 6.3% total returns against the 13.8% of the S&P 500. But this picture looks a bit different when we zoom out and look at the last 10 years. During this time, Google did outperform the S&P with 430% versus just 250. Google's recent dip in performance is a clear sign that investor confidence is a bit shaky right now. And honestly, it makes sense. With AI rapidly evolving, the core search business looks to be on the brink of disruption. And on top of that, Google is also facing a couple of lawsuits which add even more pressure to the mix. I had pretty much the same concerns until I recently started to dig deeper into Google. But what I found actually surprised me. So first, let's look at the actual data and compare how many people use search engines compared to chatbots to see if the business is indeed being disrupted. And in this infographic from One Little Web, we see that search engines are visited 34 times as often as chatbots. And Google has the top spot by far. On a year-over-year basis, the visit amount to Google has actually dropped, but only by 1.4%. But when we look at the month-over-month data down here, the traffic has actually increased in the last month. And yes, chatbots are experiencing an explosive growth right now. 80.9% year-over-year. But for the moment, I would say that they are rather used in combination to search engines instead of replacing them. And Google has already implemented these bots into their search. So they are already getting a piece of this pie. With their Google AI, they are actually already a big player in this market, and I would even argue that they currently have the best position of all players to provide a full AI solution. Hear me out on this. It starts with Google's research papers on generative AI being cited 3 times as much as any other company or institution in this space. That could mean one of two things. Either Google is generating a lot of output, or they are doing groundbreaking work here that finds a lot of attention. I am not deep enough into these topics to know which is the case, but when a company is filing many patents and are cited a lot, it does mean something. And the monthly token usage ranking from OpenRouter also shows that Gemini 2 Flash was the most used model last month. And it is not the only model from Google in this ranking. In the top 10, we even find 5 different models from Google. And from all the companies on this list, Google is the only one that is also providing the cloud and hardware to run their AIs on. Anthropic, for example, is also known for their very clever models. But they are completely dependent on external hardware to run their AI on. But Google isn't even stopping at the cloud. They are also developing TPU chips to run the inference on. These chips are now in their 7th generation already and are specifically designed for inference with high efficiency, which allows them to run AI workloads very cost effectively. The difference to GPUs like Nvidia's chips, for example, is that GPUs are better in training large AI models, while these TPUs are actually quicker and more efficient in running the day-to-day operation of AIs with a very low latency or reaction time. In some cases, they can even be more efficient for training, but only when they are tightly integrated with the AI models, as is the case for Gemini. As Dylan Patel points out in this article on semi-analysis, the key KPIs for data centers or AI factories, like Jensen Huang calls them, are latency, interactivity, that's how many tokens are generated, and the context window or short-term memory. And the hardware power of Google makes it possible for them to offer insane performance for free. For example, their coding AI, Gemini CLI, offers 60 requests per minute and 1000 requests per day totally free of charge, while the same service with Anthropic's Claude Code is pretty expensive. And Anthropic isn't doing this to milk their customers. For them, the expensive price tag is pretty much necessary so they can run the models on external clouds. I am actually currently invested in Meta for a couple of reasons. One of them is that I like the open source AI approach with their Llama models. And Meta recently made headlines with their aggressive approach to poach experts from other AI companies like Google or OpenAI. Zuckerberg wrote an internal memo, and I actually managed to get exclusive footage of this here on the channel. I believe that this will be the beginning of a new era for humanity, and I'm fully committed to doing what it takes for Meta to lead the way. So, first of all, welcome to the club. That's what experts have been saying since ChatGPT hit the public 2 years ago already. And second, the last time you were fully committed to anything, it was augmented reality. And up to now, this has led to nothing. It also seems to me that Meta is just trying to fight problems with money. This does work to a certain degree, but it only goes so far. This video is about Google, not Meta. But my point here is that I start to believe more and more that Google is by far the stronger player in the AI space and might also be the better investment. And while we are at the topic of investing, Google is also investing a lot of money in their cloud and AI infrastructure. This year, they want to spend $75 billion on this, which also includes a small modular nuclear reactor to power their data centers. And in the first quarter of the year, they already spent $70 billion in capex total. This is up by 43% since the first quarter of last year. They also announced in March that they will acquire the cloud-based cybersecurity company Wiz. And while it will keep its multi-cloud support, so it can also be used in AWS or Azure, the native integration with Google's security operation has the chance to improve the threat detection and response here. Now, we have talked about search engines, cloud and AI. And these are also the segments where Alphabet earns its money. Here are the latest numbers from the last quarterly report. More than 50% of their revenue is generated with Google's search business. And all segments except their networking business are also still growing nicely. When we look at the cloud business alone, we also see that it's still growing like crazy. Year over year, the revenue has grown by 28%, which has more than doubled their operating income here and has pushed their operating margins from 9.4 to 17.8%. This is almost double the margins they had a year ago. But to see the complete picture, we actually need to dig into their 10Q report. Because here we find that the cloud only makes up 13.5% of the total revenue, while Google services are still the major contributor here. And we also find the category Other Bets here. This is also generating revenue, but an operating loss. This is what they call moonshots. These are highly risky but potentially disrupting technologies. In the past, this included the acquisition of YouTube and Android. Their AI development also started out here. Right now, they are working on quantum computing and their self-driving company Waymo that is already providing full autonomous ride-hailing services in multiple cities. With this, they are by far the market leader when it comes to autonomous driving with over 200,000 paid rides per week. And even though Tesla usually gets a lot more media coverage on this, Waymo is already far ahead of Tesla even if Elon wants us to believe otherwise. These experiments are not generating much revenue for Alphabet at the moment. But I believe that many investors are underestimating their long-term potential, especially when viewed as part of the broader ecosystem. Let me give you a couple more examples. In addition to the two fields I just mentioned, we also have the drone delivery company Wing here that is already able to deliver meals or medicine to remote areas. And just last month, they announced a partnership with Walmart, which might just make them the world's largest drone delivery company. We also have Isomorphic Labs that is working on AI-based drug discovery. This area is still a bit out of the spotlight, but might become one of the most important applications for AI soon. And going in a similar direction, we also have Calico that is using AI to understand the biology that controls aging and diseases that are associated with the aging process. And because they all belong to Alphabet, these companies all have access to Google's cloud and AI technology, which gives them a competitive edge against others in their fields. And guys, the research required to find these connections is pretty time intensive because it goes beyond just reading and summarizing a couple of articles or numbers. So if you want to see more of it, please subscribe to the channel to not miss my next video. Also, feel free to hit the like button to let me know that you appreciate this kind of work. As a side effect, it also really makes my day, so thank you very much. And while I do believe that these moonshots show the innovative nature of Alphabet and some of them will become profitable companies and can even complement the other business in the long run, like quantum computing combined with AI, the growth of AI and cloud will still be the biggest revenue drivers in the medium to short run. So let's have a look at the general market for these areas next. First, according to Flexera, the cloud that is most used on a regular basis, here the blue and the purple bar, is still AWS, followed by Microsoft's Azure. Google's cloud comes in at third place and is actually quite a bit behind the other two. But many companies are experimenting with Google Cloud and an additional 7% are already planning to use it. The overall cloud computing market is also still growing very quickly with an expected annual growth rate of over 20% until 2030. And the AI cloud market should even grow at double this speed. Here, the annual growth rate is forecast to be at almost 40% until 2030. Even the search engine market should still grow with a CAGR of 10 to 11% for the next 8 years. That's not too shabby for a market that is already written off in the eyes of many investors. And even though it is with Waymo only a marginal portion of the business right now, the autonomous vehicle market is also expected to grow with 20% for the next years. So even the current main market, the search engine market that is also the slowest growing market, is still forecast to grow with double-digit growth rates for the foreseeable future. And with all we have seen up to now, I think that the concerns that Google's business might be disrupted soon are pretty overblown. But there are also other risks to consider. For example, Google has several lawsuits, mostly antitrust matters going on right now, of which the outcomes are still uncertain. The European AI Act could also potentially restrict data flows, which might delay the integration of certain services on a global basis. It could also lead to Google being forced to split off some of their businesses, which I actually wouldn't find too bad, because it could lower the conglomerate discount and even push the price of each individual part. And of course, the heavy investments in AI infrastructure is also inherently risky if it can't bring long-term value for the company. As this whole AI space is also still quickly evolving, Alphabet could be disrupted from faster moving rivals here. So now that we better understand what Alphabet is actually doing and how the different markets look like, let's also check their financials. Income-wise, Alphabet shows a very nice and steady growth over the years. We see a very nice and steady growth over all of these metrics, from top-line revenue growth to bottom-line free cash flow growth. In the pandemic year 2021, we see a jump in several metrics due to increased e-commerce and higher online engagement, which led to a higher advertising revenue for Google. They also bought back shares for $50 billion that year, which further boosted their EPS. So, on average, the company could grow their revenues with 16.6% every year for the last 5 years and their free cash flow by 22.6% even. The EPS was boosted even further by share buybacks and did grow by almost 30% every year. But they did not only grow their income. They could also grow most of their margins over time. Their gross margin shows a slight uptrend in the last years, but over a time frame of 10 years it is pretty much stable. The same is true for the free cash flow margin that is fluctuating a bit on a year-over-year basis and is even below their 5-year average right now. But this is nothing to worry about and only shows the insane investments in AI and cloud infrastructure right now. The EBITDA margin and the return of invested capital are still growing nicely, with the ROIC being at a whopping 30%. So we have a gross margin of 58% an EBITDA margin of 36.5%, free cash flow margin of 20.8%, and a huge return of invested capital of 30.4%. These are all well above the sector medians. Their balance sheet is also pretty clean, even though their debt level has risen slightly over the years. But the current net debt to EBITDA ratio is still at minus 0.5, which means that the company has more cash on their hands than debt on their books. A new metric that I'll also show in my analysis from now on is the interest coverage. I think this is an even more important metric than the net debt to EBITDA ratio because it shows the operating income divided by the interest expense. It basically shows how much of the operating income the interest payments make up, or rather, how many times the interest expenses can be covered by the operating income. A higher number shows a better coverage, and in our case today, Alphabet can cover its interest payments 242.8 times from the operating income. So there is a lot of margin here. Very observant viewers might have noticed that the cash and cash equivalents up here are actually lower than the long-term debt. This should indicate that the net debt to EBITDA ratio is positive instead of negative. So why is it negative in this case? As always, we find the answer in the 10Q report. Here we see that Alphabet has significant marketable securities in their balance sheet that are also highly liquid and need to be included in this calculation. And combined with the cash, this sums up to $95 billion, which is indeed double the amount of long-term debt. So they do indeed have a long-term debt to EBITDA ratio of minus 0.5 times and interest coverage of 242 times. And they are also buying back shares on a pretty insane level. Over the last 5 years, they have bought back 3.8% of their shares every year. The only hair in the soup that I could find was the stock-based compensation that makes up more than 30% of their free cash flow now. In the last 10 years, it has also grown quicker than their cash flows. But recently, this trend seems to slow down a bit, which is a good sign. It is still something that investors in the company should keep in mind. I would definitely keep a close eye on this to see where it is going. But back to more positive news. Just last year, they started to pay a small dividend in addition to the huge share buybacks. Right now, the yield sits at 0.47% with a payout ratio of only 10%. And they have already announced a 5% increase of this dividend for this year, but we still need to see where this is going from here. So all in all, Alphabet is unsurprisingly a financially very healthy company with great profitability that is still growing pretty quickly. They are also rewarding their shareholders with huge share buybacks and recently also a small dividend. But in order to see if they are also a good investment, some pieces of the puzzle are still missing. We also need to check their growth expectation for the next years as well as their current valuation. The 63 analysts, good lord that is many, that give a one-year price target on the company are pretty optimistic. They see a one-year upside of 12.7% and give a strong buy rating. They also expect the EPS to grow by 13% annually for the next 3 years and their revenue by 10.3%. Their valuation is also not very expensive for such a quickly growing and strong company. Their PE is at 20.1, their EV to EBITDA at 15.6 and their price to cash flow at 32.3. The PEG ratio sits at 0.53 right now. These values are all above the sector medians. Compared to my other videos, I also had a slight change here. In the past, I've used the forward-looking metrics here. And now I have changed this to the trailing 12 months values. The reason is simple. I am currently learning and studying the predictive values of certain metrics for my upcoming stock scoring system, or quant rating if you will. And here I learned that the TTM values do indeed have a higher predictive value of the stock price than the forward-looking values. Mostly because the forecast uncertainty that comes with the forward-looking values. So from now on, I will use the TTM values instead. Unfortunately, I also learned that the predictive value of my favorite valuation metric, the PEG ratio, is also not so high for pretty much the same reasons. I will still show it here because I still believe that it gives at least some context to the PE ratio, even if it is not 100% accurate and depends on the growth forecast. When we compare the valuation to their own history, the company does indeed seem to be rather cheap right now. The PE ratio is close to the lowest it has been in the last 10 years, and the EV to EBITDA and price to cash flow are also well below the 5-year average. So last but not least, before I sum this up and come to my conclusion, let's also compare them to some peers. Due to the diverse nature of Alphabet's business, it is a bit tough to select appropriate comparisons here. Most of the companies I choose as comparison do not have a business that is 100% comparable. So please take this with a grain of salt. The companies I choose are Meta, because I'm actually debating in selling my Meta stocks and change my investments to Google, Microsoft, Tencent Holding, and Baidu. From these companies, Microsoft had the best performance in the last 10 years, followed by Meta. Google comes in at third place, mostly because of the better performance from Meta in the last 2 years, while both Chinese companies are on the 4th and 5th spot. All except for Baidu are paying a small dividend, but both Meta and Google have just started paying it recently, so we don't have many years of growth data yet. Tencent could actually grow the dividend the quickest in the last 5 years. The payout ratio of all of these companies is also still very low, so there is much room for them to grow. Valuation-wise, we see a huge gap between the US companies, especially Microsoft and Meta, and the Chinese companies. From our 3 US companies, Alphabet has the lowest valuation, which is actually quite a bit below the other 2. But this also comes at a slightly lower growth. They are actually pretty much on par with Microsoft and can even beat them in terms of free cash flow and EPS growth. But Meta did still grow quicker. Both Chinese companies saw a lower growth in the top line, but could grow their bottom line with the free cash flow pretty quickly in the last 3 years. And none of these companies needs to hide their margins. These are all pretty good, but both US companies have outperformed Google here. So it seems that their third place in terms of performance is actually well deserved. So overall, I think that most concerns for Google are overblown right now and that they do have a lot of potential. Especially their AI ecosystem with Gemini, their own cloud and their own TPUs is very interesting. And when we factor in their research on quantum computing, autonomous driving, healthcare technology and even drones, we do have a very unique mix here that we can't find anywhere else. Of course, most of these initiatives are still very young and largely unproven. But Google has a history of turning ambitious moonshot projects into major successes, so I wouldn't dismiss them outright. That being said, it will likely be years before any of them can make a meaningful impact on the company's revenues. But that's just how I see it. What do you think about the company and the sector? I would be really interested to hear your thoughts down in the comments. And guys, in the last month I have bought heavily into Novo Nordisk. If you would like to know why, check out my full analysis on them right here. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.